Hello and welcome to Module 3 of our journey through the world of payments. In this module, we're diving deep into one of the most important and widely used payment instruments globally, credit cards. Today's lecture is all about getting to know credit cards from the ground up. We'll explore how they came to be, how they've evolved over the decades, and how they've become an essential part of modern commerce. Let's begin with a simple question. Have you ever stopped to think about what your credit card really is? Sure, it's a thin piece of plastic, or maybe metal, if you're fancy, with a number on it and your name. But that little card represents a powerful financial agreement, an ecosystem of banks, networks, risk models, rewards, and global infrastructure. To understand how we got here, let's take a journey back in time. The origins of credit. The concept of credit has existed for thousands of years. Ancient Mesopotamians used clay tablets to record debts and promises to pay. Even in ancient Rome, merchants extended credit to trusted clients. However, these systems were informal and based on personal relationships, reputation, and mutual trust. Fast forward to the 20th century. In the 1920s, US department stores and oil companies began issuing proprietary charge cards to loyal customers. These early cards were store-specific and couldn't be used elsewhere. You could use your charge card to fill up your car or buy clothes, but only at that specific merchant. This system worked well for repeat customers, but it was highly fragmented. The birth of the modern credit card. The breakthrough came in 1950 with the launch of the Diners Club card. Diners Club introduced the first general-purpose charge card that could be used at multiple restaurants in New York City. It was made of cardboard and had to be paid off in full at the end of each month. It wasn't a credit card in the way we know it today, but it laid the groundwork. In the late 1950s, Bank of America introduced the Bank Mastercard in California, the first true revolving credit card. This was a game changer. Customers could now pay only part of their balance each month and carry the rest forward with interest. This concept of revolving credit became the core of modern credit card systems. Bank Mastercard eventually evolved into what we know today as Visa. Meanwhile, other banks formed alliances and launched Mastercard, which later became Mastercard. American Express entered the credit card market in 1958 and quickly gained traction among business travelers. Discover came along later in 1985, offering competitive terms and cashback rewards. Expansion and globalization. The 1970s and 1980s saw explosive growth in credit card use. As card networks expanded globally, so did acceptance. Merchants signed on because accepting cards brought more customers and bigger purchases. Consumers loved the convenience, and banks saw it as a new revenue stream. Key developments during this time included the magnetic stripe card, which standardized card technology, the creation of secure processing networks, the rise of point-of-sale POS terminals in stores. With international growth came the need for global settlement, compliance, fraud detection systems, and standardization, all of which shaped the modern credit card ecosystem. From plastic to digital. The 2000s brought a wave of innovation. Chip cards, also known as EMV cards, were introduced to combat fraud. Instead of storing static data like magnetic stripe cards, chip cards use dynamic data that makes it harder to clone or skim. Then came contactless cards and digital wallets like Apple Pay, Google Pay, and Samsung Pay. Now, you don't even need a physical card. A smartphone or smartwatch does the job. Virtual cards and tokenization have added even more layers of security. Today, we have credit cards that live entirely in apps, offer real-time spending alerts, and even change card numbers after each transaction for enhanced safety. The credit card ecosystem today. So where are we now? Credit cards are a central part of the modern financial ecosystem. They serve multiple functions as a line of credit for consumers, as a revenue generator for banks, as a purchase method for everyday spending, as a platform for rewards, points, travel perks, and cashback. The players involved in a single credit card transaction include the cardholder, you, the merchant, the acquiring bank, the issuing bank, the card network, Visa, Mastercard, etc., the payment processor. It's a sophisticated system that makes global commerce possible, securely and in seconds. Let's reflect. When you pull out your credit card to pay for a coffee, there's a lot more going on than a quick swipe or tap. That card represents decades of innovation, competition, risk management, and evolving consumer behavior. And this is just the beginning. In the coming lectures, we'll explore how credit card transactions actually work, how networks and issuers collaborate, how interchange fees are calculated, and how fraud is detected and prevented. We'll also discuss the business side of credit cards, why banks issue them, how they make money, and how consumers can use them wisely. Summary. To recap, here are the key takeaways from today's session. Credit cards evolved from ancient credit systems and early 20th century charge cards. The first modern credit card with revolving credit was launched in the late 1950s. Card networks like Visa, Mastercard, Amex, and Discover expanded card acceptance globally. Technology has driven the shift from magnetic stripes to chips, contactless, and digital wallets. The credit card ecosystem today is vast, complex, and essential to global commerce.